The internal rate of return, or IRR, is one of the most widely used metrics in all of commercial real estate, but this also tends to be one of the least easily understood. The textbook definition of the IRR is the discount rate at which the net present value of a set of cash flows is equal to zero, which for the vast majority of people not coming from a finance background doesn't really mean much of anything. But if you're looking to land a job in the commercial real estate industry as an analyst or associate, trying to raise capital from equity partners to fund your own deals, or even considering investing passively in a crowdfunding or syndication opportunity, being able to both understand and interpret this metric is really important in the decision-making process. So to help make this topic more clear and to give you some context around why this metric matters so much in this industry, in this video, let's talk through what an IRR actually represents, the applications of this metric on real estate investment analysis specifically, and how IRR values for investors can impact the entire commercial real estate market on a very large scale. So to simplify the internal rate of return and to apply this into a real estate context, you can think of the IRR metric as the annualized time-weighted return on capital invested in a given real estate deal. And the time-weighted portion of this definition is one of the most important pieces of the puzzle here, and with that, the first thing that you need to know about this metric when using this to analyze a deal is that because the IRR is a time value of money calculation, this number is going to be heavily dependent on when each contribution and distribution occurs on a deal. The concept of the time value of money essentially states that a dollar received today is worth more than a dollar received tomorrow, and this is directly applicable to the internal rate of return, meaning that cash flows distributed earlier on in the analysis period increase IRR values more than those same cash flows would if they were distributed later. And the implications of this in a real estate context are that deals with an early refinance or business plans that call for a quick renovation and sale are often inherently going to see higher IRR values than similar longer-term hold options, even if the deal isn't necessarily as profitable overall, which could be a big shortcoming of this metric if relied upon exclusively. And to illustrate this with an example, let's take a look at a deal with a $10 million purchase price with a 5% going in cap rate and a 10-year projected hold period with an assumed exit cap rate when the property is ultimately sold of 5.5%. This deal will also be financed with an interest-only 65% LTV loan at a 4.5% interest rate, and because of a significant renovation planned, the net operating income on the deal is assumed to increase by 15% in the second year of the hold period, 10% in the third year of the hold period, and 3% all the way through the rest of the analysis, which altogether produces an IRR value of 16%. However, if all we do is change our projected hold period from 10 years down to 3 years, keeping all other assumptions the same, the IRR on the deal now jumps from just 16% to almost 22% with the same exact operations, even with a significantly lower projected sale price and a total profit figure that's less than a third of what we would generate in the 10-year hold scenario. This also doesn't factor in things like transaction costs, capital gains taxes, or the risk associated with an IRR value that's so heavily reliant on sale proceeds specifically, which is why this metric can sometimes be misleading when relied on too heavily on its own, and why looking at this metric alongside other metrics like the equity multiple or the total profit expected on a deal is a necessary step when running an investment analysis. Now, aside from just the timing of the cash flows on individual deals, another important thing to note about the IRR is that this metric is a core part of property valuations in the commercial real estate market as a whole, especially among institutions and major private equity firms. Most large investment firms that control a significant portion of the overall capital flows in commercial real estate won't raise money on a deal-by-deal basis, but instead raise capital in discretionary funds, which are generally going to be advertised with a target IRR up front that's relative to the risk that the investors will take on. So for example, if a private equity firm goes out and raises $10 billion for a value-add fund with a 15% IRR target for investors, the deals that go into that fund and make it through the internal investment committee need to be able to hit that 15% IRR, meaning that valuations for the company's acquisitions are going to be heavily determined by their ability to get to that number on each deal they pursue. This is a huge reason why cap rates tend to follow interest rates, since even though net operating income values don't immediately change when interest rates change, IRR values at the same valuations can change significantly with rising or falling rates, which means that investors that raised capital with a specific return expectation up front will often immediately need to adjust their valuations when interest rates fluctuate over time. And again, to put this into context with another tangible example, let's assume we're working for a major private equity firm that recently raised a value-add fund with a 15% IRR target and a 7-year fund life. Let's also assume that we're analyzing a deal to go into this specific fund with a going-in NOI of $450,000, assumed NOI growth of 15% in year 2, 10% in year 3, and 3% in each year after that, an assumed exit cap rate of 5.25%, and a full-term interest-only loan at 65% of the purchase price at 4% interest. And in this scenario, to hit our target returns, we would reasonably be able to pay $10 million for this specific deal. However, if interest rates jumped up from 4% all the way to 6%, not unlike what we've seen this year, that IRR, given those same operations, would all of a sudden drop to 12.0% at that same $10 million offer price. And just to get back to that 15% IRR value, we would need to decrease our valuation by $700,000. This can ultimately create a cascading effect in the market, affecting valuations upward or downward on a very large scale very, very quickly, which puts the IRR metric really at the core of property pricing throughout a significant portion of the real estate market. Now, the last thing that I want to make sure I point out about the IRR is that while this metric is commonly used for valuation purposes, the IRR is also very commonly used to determine cash flow splits between partners in joint venture equity waterfall structures. Cash flow distributions on real estate deals tend to be irregular, with part of the investor's returns coming from operations and another part of the returns coming from sale proceeds. And because of this, the IRR is a great way for investors to both understand and compare the overall returns of a real estate deal to other investment vehicles they might be considering, like stocks, general private equity, or venture capital investments that might only produce one cash flow distribution at the time the asset is sold. This is also really important to know whether you're a sponsor or a passive investor or even just an employee of a company, since the amount of promoted interest earned in these types of structures is often going to be heavily dependent on the business plan of the deal. So if you're working at a private equity firm and trying to maximize your promote, you may lean more heavily towards short-term hold periods and a quick return of capital to investors. But if you're a limited partner investing passively in deals, you may be looking for longer-term hold periods to avoid unnecessary transaction costs and to make sure the sponsor performs well over time before paying out that promoted interest amount. Many sophisticated equity sources that will come in as the sole limited partner on a deal will even go so far as to push for multiple preferred return hurdles based on both an IRR and an equity multiple to make sure that the whole dollar amount being returned to investors is going to be significant and worthwhile given the time and energy necessary to analyze a deal. There's a common saying in real estate that you can't eat an IRR, and while this metric might look impressive on paper, it's important to understand the time period over which that IRR is generated, how the partnership is structured, and the motivations of the sponsor, and whether the total profit that's expected on the deal makes the investment worthwhile to get involved with in the first place. And if you want to learn more about IRRs, equity multiples, cash-on-cash returns, and the other real estate finance metrics that are commonly used in the real estate investment analysis process, as always, make sure to check out our all-in-one membership trading platform, Breaking a CRE Academy. A membership to the Academy will give you instant access to over 120 hours of video training on real estate financial modeling and analysis. You get access to hundreds of practice Excel interview exam questions, sample acquisition case studies, and you'll also get access to the Breaking a CRE Analyst Certification exam, which covers topics like real estate pro forma and development modeling, commercial real estate lease modeling, equity waterfall modeling, and many other real estate financial analysis concepts that will help you prove to employers that you have what it takes to tackle the responsibilities of an analyst or associate at a top real estate firm. And if you like this video and want to see more deep dive content like this on specific real estate return metrics, make sure to hit the like button and let me know in the comments which metrics you focus on most to come up with your valuations. As always, thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already to see more videos like this every single week, and I'll see you in the next video.